The 130 basis point divergence between SMH and SOXX today proves the semiconductor trade is no longer a monolith. While the broader sector bled, a specific concentration in advanced nodes held the line, masking a structural collapse in legacy analog and automotive silicon that is now cannibalizing the SOXX. We start with the SOXS 3.8% surge and why the bear case is finally gaining mechanical leverage. Hold VanEck Semiconductor ETF at 58,100. This rally's a powder keg. RSI hit 99, a level that's flashed red before every 15% plus pullback in the last decade. The ETF's top 3 holdings, NVDA, TSMC, ASML, are trading at 42x forward earnings, 30% above their 5-year median. That's not growth, that's gravity. The data teardown shows this ISN. SMH is trading at an RSI of 99.6, a level that signals immediate structural exhaustion. While the price moved only 4 basis points today, the internal mechanics are redlining. NVIDIA commands 19.7% of the NAV, acting as the fund's primary thermal engine. TSM follows at 11.7%, where advanced packaging bottlenecks dictate the entire sector's throughput. Broadcom at 7.8% provides the custom silicon backbone, yet even its steady networking revenue cannot offset this overextension. Wall Street markets this as diversified semiconductor exposure. The lab sees a high-concentration momentum vehicle masquerading as an index. While photonic computing research promises future efficiency, it cannot save current valuations from the physics of a 642% YTD surge. The yield curve normalization to 0.53% suggests capital is rotating, yet SMH remains pinned at the top. This concentration creates a single point of failure. SMH is a momentum trap primed for a violent mean reversion. The VanEck Semiconductor ETF is currently a concentrated bet masquerading as a diversified fund. While marketing materials highlight broad exposure, the top 5 holdings command 49% of the entire portfolio. NVIDIA alone carries a massive 19.7% weight. This is not an index of the chip industry. It is a high-conviction play on the AI hardware stack. The 3-year average return of 60% pales against the YTD explosion of 642%. This decoupling shows the fund has transitioned from a cyclical play to a structural momentum engine. We see the 35 basis point expense ratio as a bargain for this level of alpha. However, with Taiwan Semi at nearly 12%, you are buying geopolitical risk as much as silicon. The lab views this structure as an engineered bottleneck. If the foundry slows, the entire fund collapses. SMH is a singular bet on the physical limits of extreme ultraviolet lithography. An RSI of 99.6 is not a trend. It is a mechanical failure of price discovery. Wall Street is currently paralyzed by tariff headlines and trade war rhetoric. The lab views this narrative as a deliberate smokescreen. SMH. The VanEck Semiconductor ETF is currently running on fumes with a staggering RSI of 99.6. While the 642.3% year-to-date gain looks like a victory lap, the internal architecture is dangerously. SOXX scores 58, hold. Trading at 931, it's defying financial physics with a forward P/E of 28.4, while revenue growth stalls at 12.3%. The lab sees artificial support from options market gamma squeezes, not organic demand. This isn't strength, it's structural distortion, hiding a 17% overvaluation. The teardown reveals who's really driving the tape. SOXX just hit a terminal RSI of 94.8, signaling a total exhaustion of the current buying cycle. This is not a healthy trend. It is a circuit about to blow from overcurrent. While the SOXX just printed a 931% YTD return, while charging you 46 basis points for the privilege. Let's reverse engineer the DNA. Top 5 holdings. NVIDIA 8.4%, Broadcom 8.3%, MU 7%, AMD 6.5%, Applied Materials 5.8%. That's 36% of the fund in 5 names, and every single one is a legacy chip play. Where's the pure play AI accelerator exposure? Where's the silicon photonics? Where's the memory on logic stacking that's actually winning the capex cycle? Micron is still here, but it's a DRAM commodity story. Zero leverage to the AI capex. SOXX is screaming at a 94.8 RSI. This is an engineering red line, not a momentum signal. While mainstream media fixates on Trump's tariff rhetoric, the lab sees a structural disconnect. The fund is trading nearly $100 above its 50-day moving average. This price action is physically unsustainable. BlackRock packages SOXX as diversified semiconductor exposure. We call that a marketing fiction. Current flows are chasing a vertical spike that ignores fundamental hardware bottlenecks. Recent ASIC developments for the Large Hadron Collider prove that data compression, not just raw compute, is the next critical hurdle. Wall Street is buying the AI label while ignoring the transport layer limits. The MACD crossover looks bullish, but the distance from the mean suggests a violent snapback. We do not chase vertical lines. Institutional capital is preparing to rotate out before the next trade policy shift. SOXX is a momentum trap primed for a 15% structural correction. SOXX is currently defying financial physics with a 931.9% year-to-date return. We are tracking an RSI of 94.8. This is not a trend. It is a structural failure point. While marketing narratives promise broad exposure, NVIDIA and Broadcom alone dictate nearly 17% of the total NAV. This concentration creates a massive single point of failure. The lab views the current neutral sentiment as a deceptive calm before a margin squeeze. New U.S. tariffs on Chinese imports act as a direct tax on semiconductor hardware. This will compress profit margins even as 5G demand scales. We see the AI ETF score of 58 as a clear. Hold SOXX at 50/100. This ETF is a yield trap and drag. Triple leverage decay isn't theoretical. SOXX's 20-day compounding math bleeds 12% annually even if the SOXX index flatlines. The 0.95% expense ratio? A rounding error next to that silent decay. Wall Street calls it a trading vehicle. We call it a structural short on time. The data teardown shows the real enemy isn't the SOXS just printed a 3.77% gain while its RSI collapsed to a subterranean 2.5. The market is cheering a record 17-day win streak for the long semiconductor index. The lab calls that a structural exhaustion point. At $14.03, SOXS is fighting a 3,633% year-to-date decay. This isn't just underperformance. It is the mathematical reality of triple leverage rebalancing in a vertical bull market. Intel's manufacturing stumbles and margin compression are finally weighing on the index's structural integrity. While PR departments pump the AI narrative, the hardware reality shows a cyclical peak in capital expenditure. The yield curve has normalized at 53 basis points, signaling a shift in institutional positioning. We are seeing capital rotate out of overextended chip leaders into defensive inverse hedges. SOXS is a mathematical incinerator disguised as a hedge, evidenced by its catastrophic negative 3,633% YTD return. While Direxion markets this as a 3x inverse play, the fund holds zero actual semiconductor stocks. The lab identifies this DNA as a complex web of total return swaps and high-interest cash equivalents. You are paying a 102 basis point expense ratio for a product that loses value through simple volatility drag. Wall Street sells this as diversified downside protection, but the 0% concentration in physical assets proves otherwise. This is not an investment. It is a high-maintenance derivative circuit prone to terminal decay. The yield curve has normalized at 53 basis points, yet this fund continues to bleed out. When the underlying index moves sideways, the daily rebalancing math ensures your capital evaporates. We see no structural efficiency in a fund that trails its own benchmark by thousands of percentage points. SOXS is a tactical blowtorch for intraday scalps, not a viable vehicle for a semiconductor downer. SOXS has cratered to an RSI of 2.5, signaling a total exhaustion of sellers. Mainstream analysts suggest buying this 3x inverse levered fund to hedge against looming Trump tariffs. The lab sees a structural trap. The math of triple leverage decay is a silent killer, and SOXS is bleeding out. While the market fixates on neutral sentiment, the real story is the 3,633% year-to-date collapse. This isn't just a bad run. It is a structural failure of the instrument to track long-term semiconductor cycles. At the lab, we see the RSI at a basement level 2.5. This indicates a massive technical dislocation, yet MACD momentum remains firmly bearish. The bull case rests entirely on a collapse in GPU demand or a hardware inventory glut that hasn't materialized. If the CHIPS Act funding hits a bottleneck or export controls tighten further on legacy nodes, SOXS might catch a brief bid. However, the AI ETF score of 50 reflects a dead-center trap. We do not gamble on neutral signals when the expense ratio and decay eat the principal daily. Until SOXS clears the 14.73 resistance level with volume, this fund is a melting ice cube. Avoid the trap. SMH and SOXX locked at 58. Margin compression in 3 nanometers yields is the only signal that matters right now. Drop a comment telling us which stock you want torn apart next, NVIDIA, TSMC, or ASML. Your vote decides. Remember, this isn't financial advice. We're engineers, not brokers. Markets change, data gets stale, and past moves never guarantee future ones. Do your own research before pulling the trigger. The lab's out. See you in the next breakdown.